Hi students, now that we've wrapped up with Unit 2, we're ready to dive into Unit 2 homework, and this will deal with chapters 4 and 5 in the book. So let's go to the Excel file. Okay, should appear in the highlighted cells, and in several of these problems I've developed, the book has, or I've developed case A and case B, or year 1, year 2, and I'll show you how to do it in case A, then you'll complete it in case B. So we'll do part of it together, you watching the YouTube video, working with the Excel worksheet open, and then do the rest on your own. So we'll do a lot of kind of side by side. I'll hold your hand and show you how to do it. And then these yellow highlighted problems over here, and notice that there's some of these tabs have more than one problem. So this one has 5, 6, 7, and 8. This is all you, baby. This is the highlighted ones are all you to do on your own. But by the time we get to here, we will have learned how to do every one of these kind of calculations within Excel. So hopefully not too intimidating, because we will have practiced it quite a bit, so you should have a feel for it. So let's get started on problem 4-1. It says you are interviewing for an entry-level financial analyst position with Wayne Industries. Bruce Wayne, the senior partner, wants to be sure all the people he hires are very familiar with basic accounting principles. He gives you the following data and asks you to fill in the missing information. Each column is an independent case. Okay, so let's start with case A. So I've got revenues, but I don't have expenses and I don't have net income. You might be thinking, how could I figure net income if I don't have expenses? Well, we're going to have to kind of piece it together. I have retained earnings, dividends. I have the change. I have the change in retained earnings over the year. So retained earnings went actually down by 30,000. I have current assets at the end of the year. All right, so where should I start? Well, I know that net income from a balance sheet perspective is divided into the change in retained earnings plus dividends. Those are the only two things that can happen with net income. So I know what my dividends are. That's right here. So I'm going to start off by saying net income is equal to the dividends, because that had to come out of net income, plus the change in retained earnings. So I'm going to add the ending retained earnings minus my beginning retained earnings. So the dividends and then the change in my retained earnings from end to beginning, and note that that change went down, so that's going to be negative. So my net income is actually going to be a little bit less than what we paid in dividends. How could we pay more in dividends than we had net income? Well, we dipped into previous periods retained earnings. So income should be 40,000. And now knowing net income, I know that net income is revenues minus expenses, so I know that expenses equals the difference between revenues and net income. So I know that expenses was 160,000. Okay, so far so good. Now let's figure out some assets liability stuff over here. Here we've got our income statement type stuff. Now we're dealing with balance sheet stuff down here. So let's see. My total assets is going to be the sum of my current and non-current assets, but I'm missing two things there. So I have to kind of hold off on that. I know that assets equals liabilities plus equity. So I have current liabilities and total liabilities. Okay, so if I have total liabilities, that's the sum of current and non-current. So non-current liabilities would be the difference between total liabilities and current liabilities, right? All right, so there's my non-current liabilities. And now I've got total liabilities, don't I? That's 140. So total assets has to equal the same as total liabilities plus equity. Right now, when I have to figure equity though first to make sure to get this right. So let's work on that. Okay, for total stockholders' equity, this one's a little tricky. I know that consists of my capital in excess of par plus my end of period retained earnings. So if I add those together, that should give me my total stockholders' equity. And then I already had that factored into total assets. That's the same as total liabilities plus equity. And now that I know total assets, I should be able to derive non-current assets, which is the difference between total assets and current assets. So that's a little bit of an accounting puzzle. It's kind of fun, actually, if you're into accounting and the numbers. So, I'll challenge you to see if you can work out this side. A little bit different mystery, but the same principles will apply. So see if you can solve that one on your own. Okay, moving on to 4.2, and that's a similar kind of problem. So we have to fill in the blanks. So this one, it kind of seems hopeless at first, but let's kind of start at the bottom. I know what the tax expense was, or the tax rate, so that 92,000 is 40% of my income before tax. So the algebra on that would be 0.4 times x equals 92,000, and then to unwind that, I would simply say 92,000 divided by 0.4 equals x. So there's my income before tax, 230,000. And now I can go ahead and solve for my net income, which is my EBT minus the tax. Okay? And now we can kind of keep working backwards. My operating income less the interest expense is EBT. So I can work backwards. I can basically add these two to get my EBIT equals that plus that. And then my EBIT is my gross profit minus my operating expenses. So gross profit has to be EBIT plus operating expenses. And finally, gross profit is sales minus COGS. And I know those two, so I can algebraically solve for this one. It's the sum of those. So again, challenge, see if you can work out that same kind of math based on just the logic of the income statement on your own. Okay, moving on, 410. The following financial data correspond to Clayton West Energy's 2015 operations. I've copied it into the spreadsheet, and the book wants us to calculate gross profit, operating income, EBT, EBIT, income taxes, and net income, so everything down here. So what I've done here, this is the actual ones. I'm going to leave that for you to do, but I'll go ahead and run an example. I changed the numbers around so we can play with this and see how we do it. Okay, gross profit is going to be sales minus costs of goods. Operating income, income before interest and taxes. So we want to put in everything except income and taxes. So, I could do sales again and then subtract costs. In fact, let's do it that way. Let's do equals sales minus cost of goods sold minus selling and administrative expenses, and then let's go ahead and take the depreciation out. The only thing we don't want to include in here is interest and taxes, which are the bottom two things. Okay, so there's my operating income. Okay, now pre-tax earnings. The only other thing we're going to do, let's just go ahead and take EBIT and subtract the interest, which is up here in that cell. Okay. Now, income tax rate applies to the pre-tax earnings. So the income taxes are going to equal our tax rate times the pre-tax earnings, 95,200. So our net income is going to equal the pre-tax earnings minus the amount of the tax. Okay. So not too tricky there, just if you know the difference between gross, operating, and pre-tax earnings. All right, moving right along, 4, 16, and 17. These are similar problems. First off, we have the balance sheet for Omni Consumer Products for year-end 2014-2015. And it wants us to calculate for both years the current assets, current liabilities, and total stockholders' equity. So pretty straightforward, just remembering how the balance sheet works. So first off, current assets. And I'm going to do 2014 for both of these, and then you can do 2015. So remember, these are assets that are either liquid now or they mature, become liquid within a year. So what's going to be included there? I'm going to do this as a sum. Cash, marketable securities, accounts receivable, and let's make that a net accounts receivable because we have the allowance for bad debt, so we're subtracting the allowance for bad debts from accounts receivable to get a net accounts receivable. So let's see, are there any other current assets? Yes, inventory, prepaid expenses. So that looks like it for the current assets. It's going to work out to 35,198. Total assets. Well, that's current assets, so we can take that sum we already constructed and then add all of our remaining assets. So let's do this as add the sum of everything else. So I'm going to do net plant and equipment, land, and long-term investments. Notice I'm going to do that as a range, so I can just drag that into the sum function. So there's my total assets. Current liabilities, same principle. Liabilities that are due now or will be due within a year. So it's going to be accounts payable and accrued expenses. Total liabilities is simply current liabilities plus, there's only one other liability there, bonds payable. So I just tack that on, add it up. And then total equity, of course, is this difference between total assets and total liabilities. So this company has equity of 54,508. And do the same procedure for 2015. Not too difficult. Okay, so we can move on to 417 then. It says show whether the basic accounting equation is satisfied in problem 416. Assets for 2014. Total assets, right up here. Total liabilities were right here. And total equity was right here. Of course, it's going to be the same. So let's just prove this really quick. The total of this side of the equation, liabilities plus equity. Just grab those cell references, and I'll copy this one down. I'm trying to copy a formula. I need to just paste a value. There we go. So 66,971, 66,971. Yes. All right, you can do the same procedure and just, what we're doing here basically is just practicing getting really used to the idea of the balance sheet, how we spell out all the accounts here, and then how it always equals over here. Oh, and I just noticed something now. Their equity consists of stock and retained earnings. Now, I derived the value of equity from the balance sheet equation, but we can go down and just kind of triple check this. Let's add up the total equity. I'm just going to hit Alt equals, which sums right above. 54,508, that's what we got, 54,508. So we are definitely on the right track there. Okay, moving right along. Problem 5.1 gives us a 2015 income statement for Teletech Company. And I've copied that over for 2015. And then what I did, just again to allow me to show you with this one and then allow you to practice, actually I've made up some numbers for 2016. I just applied some growth rates, and then I'll do it for 2016, and you can go back and do it for 2015, which is the one the book has. It wants us to calculate gross profit margin, operating profit margin, and net profit margin. Now we're working with ratios based on the information in the financial statement. So here we're looking at profitability ratios. So let's review. What is gross profit margin? That's gross profit divided by sales. So that's pretty easy. Gross profit in cell D6 divided by total sales in cell D4. Gross profit 0.57. Now when we get all of these done, I'll display them all as a constant decimal or a percent even. You could display these as a percent. Operating profit margin is EBIT divided by sales. We have EBIT right here divided by sales. Bada boom. And then net profit margin, of course, is net income over sales. So where's net income? Way down here at the bottom. Divided by sales, way down here. Bottom line of your balance sheet, right? Divided by top line, that's your net profit margin. Okay, let's display those all as, let's do it as a percent. And there we go. All right. Pretty easy, right? Do the same thing for 2015. You're all set. Okay, now we're jumping way up to 533, and this is just to get us some exposure to a few more profitability ratios. The return, return on assets, return on equity, also known as ROA, ROE. We'll also look at a debt ratio here. So we've got the data for Golden Products here for 3 years, 2013 through 15. And we're going to calculate the ratios. I'll go ahead and do it all for 2013, and you could fill it out. And then the problem's going to ask us a comment comparing to the industry, and we can observe two things: the trends over time for Golden Products Company, and then compare those, both the trends and then we probably want to look at the latest numbers for the company to the industry. So you can kind of comment where this company stands relative to the industry. But let's go ahead and just calculate them for 2013. Return on assets is net income divided by total assets. So for 2013, my net income is right here, 400 million, and my total assets is right here, 3.8 billion. I already formatted that as a percent for you. My debt to assets, and then analysis, well, that's right on track with the industry, but of course we have to see what's going to happen over time, right? And if it goes up, that's good, beating the industry. If it goes down, that's not so good, we're lagging the industry. So that's for you to determine once you make these calculations. All right, debt to assets is total debt divided by total assets. That one's pretty self-explanatory. So find our total liabilities here for 2013. divided by our total assets for 2013. That's 68%. Ooh, we're starting off a little bit higher than the industry, so that looks maybe not so good, but let's see what they did with that in the next 2 years. And then return on equity, net income divided by total stockholders' equity. So net income for 2013 is right there, and then total equity is, oh, where is total equity? Not given, so we're going to have to calculate it, but that's okay, we can, right? We can use the balance sheet equation. Assets equals liabilities plus equity. I have assets, I have total liabilities. That means I can calculate equity. So equity is going to be the difference between total assets and total liabilities. So that's equity. If I wanted to, I could add a column here for total equity. And that's 33. Hey, that's looking pretty good compared to the industry, right? So we'll see what happens with that trend again over time. So a little bit more exposure to some of our other ratios. We've rounded out all the profitability ratios. We've looked at the major debt ratio. We'll look at a few other things here, and then I'll turn you loose to finish this assignment on your own. Okay, problems 5, 6, 7, and 8 are all in one sheet. Notice that there's 3 problems here, but they're all related. They're all based on the same company's financials. So we've got the income statement and balance sheet. Note that you have to scroll down to get to the bottom of that balance sheet. And we've calculated all this stuff, so use the functions, use Excel formulas, apply them. If you ever get stuck, the textbook has a summary of all the different ratios on pages 98 through 99. So just bookmark that. You can jump back there to remind you how to calculate the ratios. So we've done all of these. I think you'll be in good shape on those. The book's going to ask you to do a little industry comparison on a few of those. Put a comment in here. Find the current ratio and quick ratio. I'm confident that you can do that. Just remember, current ratio is current assets divided by current liabilities. Quick ratio is current assets less inventory divided by current liabilities. So once you add up all your current assets down here, and is this going to be nice enough to give you total current? Yeah, they even give you total current assets. So all you have to do in the quick ratio is take your total current assets and subtract out the inventory, and then divide that. Let's see if they're nice and give us total current liabilities. They do indeed give us total current liabilities, so just plug that into the bottom, and it's just that easy. Okay, so I'll delete that and let you do it again on your own. So you can work these liquidity ratios, and then you can work the debt ratios as well. We didn't look at times interest earn, I don't think, in the lecture, but it's pretty easy. It's simply EBIT divided by interest expense. So we have EBIT. I've actually got EBIT right here, operating income. And the times interest earn is EBIT divided by interest expense. Interest expense is sitting right here. So what this tells us is this company earned 270 times its interest expense. And what that does is tell potential creditors, a bank or lender, that whether this company is generating enough cash flow to pay its interest. Well, if it's generating 270 times its interest expense, it's probably in good shape to maintain payment on its debt and possibly even take on more debt. So again, I'll let you work that one again. Okay, 5, 19, 23, and 26. I'm going to leave these as challenges to you. It just deals with working with ratios. And if you know the ratios well enough, you should be able to think these out. Get a pencil and paper, scratch some things out, and then see if you can come up with those answers. And then finally, 531, we're dealing with some earnings ratios. Let me just note if there's anything challenging in here. Earnings per share, I think we talked about in the lecture, price to earning. Book value per share, I don't think we got into, but it's pretty easy. And again, look at page 98 through 99. It gives you the formula for market to book. It's just price per share divided by book value per share. And what is book value per share? Right, book value per share, and let me go ahead and add this, is the total equity divided by shares outstanding. So I'll go ahead and calculate that for you. The total equity of the company, it says in the problem, is 15 million. We have it right here. And the number of shares outstanding is right here. So book value of this company would be $8.57 per share. Okay, that's basically the value of each share based on the book value of all the company's assets, net assets, net of liabilities, net of debt. And then what we're looking to compare is the market value of the company's assets, which of course is total market capitalization, the total market value of all the shares, divided by shares outstanding. And that's going to look like this. The stock price times the shares outstanding divided by the shares outstanding. So the market cap, you'll remember, is the market value of all the shares. So the market price times the shares, then we're going to divide that back into the shares. Well, that's going to work out to our $40, isn't it? I screwed up here. That's going to work out to our market value, $40 per share. So interesting how the market's valuing this company much more than their own balance sheet is. Okay, so we can work with these concepts over here. And then market to book ratio, which they're also asking you here. Well, that's just the ratio of the market price to the book price, to the market price per share to the book value of the stock. And that tells you how much how much potential the stock market thinks there is in this company, valuing its shares above its own stated equity on its books. So if you see market to book values that are higher than 1, that tells you the market thinks there's some potential there, and the higher they get, if they get to 2, 3, 4, that tells you the market thinks there's a lot of potential there. Potential to create future earnings growth and hence grow the value of the shares. And of course the market's going to kind of bake that anticipated growth into the share price, and that's why the share price right now might exceed book value right now. Okay, so there's a few pointers. I'm confident that you can work this entire problem set, and we'll have the understanding we need of financial statements and financial statement analysis, and then we can move on to Unit 3 and start getting into some fun stuff with time value of money.